Fed. Let's bring in CFRA Research Chief Investment Strategist Sam Stovall. His S&P target is 5250. Sam, I assume you're listening to Sarah as well as she sort of maps out the path that may be taken today at the press conference and or by the Fed. How does it figure into your thinking about the broader markets right now?
Well, good morning, David. I think certainly investors, myself included, are trying to figure out which way the Fed will be going today. We're still sticking with the premise that the Fed will be slower to lower interest rates and that the first rate cut would occur in June, which interestingly is 11 months after the last rate hike, which historically has been the time span between the last rate hike, first rate cut. And then we end up seeing full 75 basis points being cut this year. But if there is a risk to that forecast, I would say that because things are looking so good, that the Fed might decide to hold off and institute its first cut in the third quarter, not the latter part of the second quarter.
Yeah. Which is better for the market? Cuts and or a strong enough economy that everybody feels pretty good about things, hence stock prices as well.
Well, I think the average investor would probably like the rate cuts, because valuations are getting a bit stretched, in my opinion. Right now, the S&P 500's PE is trading at a greater than 30% premium to its average over the last 20 years. And we're actually seeing 2024 and 2025 earnings forecasts coming down. So I would tend to say that the investors would like to have some sort of afterburners to help propel the market.
You think it's the better economy that's been propelling the market, or the AI story, or both?
In terms of propelling the market, Sarah, yeah, I think it's the AI story that is supported by a strong a strong economy, good employment trends, the direction overall of inflation, et cetera. But I would tend to say that the euphoria is really coming more from the AI area, because we've been seeing technology being among the almost absolute leaders in this overall move.
Yeah, and many of them sport multiples that still don't seem that rich, though. They may be above the market's multiple. But again, these are the largest companies that we have in the world, Sam, that are growing fairly quickly. I'm just sort of curious as how you see that, sort of those big mega caps, the handful of them, versus the broader market overall.
Sure. Well, I've been around long enough, as have you, to remember that the market thought that the PEs were cheap at 60 times forward estimates. Today, we're looking at numbers nowhere near that. Technology is trading at about a 30 multiple, and typically, at least over the last 20 years or so, that has been a pretty hefty resistance level. So I think we're going to have to see improved earnings estimates in order for technology itself to move meaningfully higher. I also acknowledge the fact that we are seeing a pretty strong first quarter relative to all first quarters going back to World War II. And if you look at those top 15, 13 of them had declines averaging 11% that started predominantly in the second quarter. So I wouldn't be surprised if we do end up with a digestion of gains occurring relatively soon.